Good evening. Lovely to be here in Edinburgh this evening, and thank you for taking some time to listen to some background and the potential of PCF Bank. We're a financial services company, recently became a bank. We were long established as a financial services company first of all, listed on the AIM market as well. So that makes us unique in that we're the only bank listed on AIM. Our strapline there, simple banking at your service. We've been open as a bank for less than 2 years. In the 16 months since we opened the doors to savers, we've taken on more than 200 million of deposits, which is a great achievement. And anyone interested in the investment case, great. Love to talk to you about it. But if you're an interested saver as well, please look at our savings rates and the ease of saving with PCF Bank, which is a seamless experience for us. There is a presentation that you can take away this evening, and it will be on our website as well. There are some appendices there which I wasn't going to go through in detail tonight, but depending on the questions, we might go into them at some granular data for you on the business. And just to head up that our interims are out on the 5th of June. So some of the numbers in here are our last year end, which is 30th of September 2018. But I still thought it was a great opportunity to speak to a new audience. And if you like the story and you hear what you like what you hear, it gives you an opportunity to then look at our financial statements, which are coming out in 2 weeks' time, and keep track of the performance of the business. So AIM listed, as I said, specialist bank. We have 4 business lines. The first 2 of those, business asset finance and consumer motor finance, are long-established business lines that we've been in for many years. And then since becoming a bank, and more recently, we've diversified into broadcast and media finance and property finance as well. What you see commonly across all those is that we're a collateral-backed lender. So we have both the debtor and we have the assets supporting the lend. Our portfolio is 275 million, a little bit higher now, supported by 200 million of retail deposits, as I've said, and we've welcomed almost 5,000 customers to the bank. Our quality portfolio, there's some credit stats in the appendices. Low impairment charge coming from the portfolio of less than 1%. Experienced and stable management. I'm one of the founding directors. We have offices in the city and in Berkshire, and this year we're celebrating 25 years in business. So the key there is we might be a recent bank. The banking license has given us the opportunity to scale way beyond what we were ever able to do, borrowing from banks ourselves to grow the company. But the key thing is we're a successful company before we became a bank. What the bank has turned us into is a transformational business that can scale well beyond our size in the past. We've had 8 consecutive years of growth since the financial crisis. I would add that for a financial institution, we remained profitable through the financial crisis. Arrears and defaults went up, but we did remain in profit, and we didn't breach any of our banking covenants. And we've grown consecutively every year since. And we've got clear and ambitious targets and plans, which I'm happy to share with you tonight, which will help you measure our performance and our growth going forward. One of those targets was our first target of a portfolio of 350 million. And at the end of last year, when we released our finals, we actually announced we're a year ahead of the 2020 target to reach that portfolio size. So we're expecting to reach that in 2019 now. And along with that comes a return on equity target of 12.5%. We have a large supportive shareholder in Summers Group. Summers are a Bermudan-listed investment company specialising in financial services companies. So we fit very nicely in their stable. We sit alongside Utilico, which is an emerging markets fund listed in London. Waverton, which is an asset management company, the old J.O. Hambro, which they bought from Credit Suisse, and a number of other financial institutions in the group, including Bermuda Commercial Bank, obviously based in Hamilton in Bermuda. And our market capitalisation is currently 83 million. And I think as we go along tonight, you'll see that there's a potential for us fairly soon to break through the 100 million barrier, which will be a massive milestone for the business. So the investment case for PCF Bank, following the grant of the banking licence in December 16, you're given 12 months to mobilise as a bank. We actually did it in 7, and we actually opened the doors to the bank in July 17. Pre-opening those doors in March 17, we raised 10.5 million of equity. We didn't need those to be a bank, but we needed that equity to actually deliver on our growth plan. And we've now deployed that successfully. And as you can see by the 12.5 million return on equity target, we've successfully put that capital to work within our business. Just recently, we raised a further 10.75 million, 2 years almost to the day after we raised the first lot. It was a little bit earlier than we needed, but we were tempted into doing it ahead of the 31 March Brexit deadline. We thought it was sensible and prudent to get that capital tucked away. And what we're largely looking at there is we're looking at having the capital to really launch into our next stage of growth and take us onto our next targets. We look for attractive NIMs. You won't see a NIM of 7% in a high street bank, nor return on equities of 15%, nor return on assets of 3%. So we're a specialist bank looking at niche markets where we can make return. We're not just interested in scale, we're always looking to deliver profitability. The management was present during the last credit crisis. As I said, we've been a successful business for many years, so we weathered those conditions, and although I'm not expecting as difficult conditions as that going forward, should there be a difficult time, you've got a team who knows actually how to run a business in tough times. Quality and robust portfolio, which is supported by a prudent business model, which has been tested in the most difficult of times and tested over quite a long period. And I think that was probably one of the strengths of our application to the Bank of England in becoming a bank, in that they could see that the resilience that our model had in difficult times. And we do pay a dividend, progressive dividend policy. We'll never be a high-yielding dividend stock. We will be, we're capital intensive by nature, but we think it's a very good discipline to pay a dividend. On the right-hand side, you've got a share graph there since we launched as a bank, and as you can see, we've outperformed the indices since our launch of the bank, and that little drop there is the drop most recently when we raised the most recent equity, and we've already recovered part of the way from there. So where do we sit in the banking sector? As I said, we're a specialist bank. We specialise in niche sectors. We're a finance company first with a banking model to fund ourselves. So we have established business lines with proven profitability. We've launched some new products and we are diversifying our asset class, but we're not what I'd call a retail challenger bank. We're not looking to take on the high street banks and move into residential mortgages, commercial mortgages, and some of those low yielding products. We're long established, as I said. We've got our roots in asset and vehicle finance, and now we're utilising the banking licence for a lower cost of funding, and we're moving the business increasingly prime as we pass those savings costs on to the marketing effort to scale the business. And we're a non-legacy bank, so we don't have the old IT, the old systems, and the old legacy issues that the large banks have. We're agile, nimble, with good systems and the ability to grow. And I've also already said that we're unique in that we're both an authorised institution and AIM listed. So our established business lines. These business lines have been around for almost 20 years, resilient, well-established, profitable. Business finance, which is business critical assets for the private sector, UK private sector, SMEs, hire purchase and finance lease. It's the largest part of our portfolio. Large percentage of wheeled assets, but a very wide range. That's everything from light commercials through heavy commercials, through yellow goods, construction plant, through coach and bus as well. The remainder is manufacturing and engineering equipment. We use a broker-introduced model to source that business, and as of last September, it made up 55%. The average deal size is £40,000. Consumer finance, used motor vehicles for consumers. By being in the used motor vehicle market, we're avoiding competition with the manufacturer-owned captive finance companies who use finance products as a loss leader to actually sell the car. Also, you're talking about vehicles that are 1 to 2 years old, so they've taken their initial depreciation hit. We like that. You can value the car, you know the value of the car. A sector that's obviously had some mixed press, but if you read beyond the headlines, you'll see that all the people operating in the car sector are having success in the used car area, whether that be Virtue or Lookers or Inchcape. They're having success in the used car sector. It's the new car sector that's badly damaged, and we're certainly not seeing demand fall in that sector. It's an average deal size of 13,000, so a little bit less, and once again, we use a broker network. What I would say, right across both of these divisions, we don't take any residual position. So all our contracts, whether hire, purchase or lease, are full payout, down to zero. So you have an amortization of the money owed to us, which accelerates in advance of the depreciation of the asset, whether it be a business asset or whether it be a vehicle. So we're in an asset-backed position quite early. And we've launched 2 new business lines. Azul Finance, which is a broadcast and media company specialising in broadcasting equipment. That's specialist lenses, cameras, and other equipment that goes with it, such as the broadcast trucks, etc. as well. They also are looking at moving into audio-visual equipment as well. Once again, very good quality assets. A niche industry, an industry they have 60% market share in, and an industry where they're originating just short of £60 million worth of new business a year. So very attractive to us. We weren't necessarily attracted to broadcast equipment when we made this acquisition last year, although we do like the value and the way it holds its value. What we're attracted to is the business that we bought and the people behind it who have been operating in that market for 20 years and have a great understanding. And behind that, it diversifies our route to market. We're moving away from brokers, and these are direct relationships with Sony and Canon. So we have the Sony's contract to distribute all their broadcast and media equipment right across Europe. So at the moment it's mainly UK based, but there is the opportunity to become increasingly European based as well. And then more recently, we launched a bridging finance division, wrote its first deals in January. It's traditional bridging finance, where it's to finance properties bought at auction or properties that are actually being refurbished. We don't do structural renovations. We don't do development loans. 75% LTV, first charge mortgages, average term 5 to 18 months. And avoiding the competition in the residential mortgage and buy-to-let sector. These numbers are getting a little dated, so I won't spend a lot of time on them, but I just wanted to highlight to you, the amazing growth figures since we've become a bank, and these are the sort of figures that you're going to see continuing on into our current year. You've got 75% increase in new business originations, you've got a 50% increase in portfolio. We've already talked as well about the success we've had in building the retail depositor base. But profits of 5.2 million last year, up 44%. Market expectation for us this year is 8 million, so more than a 50% increase in PBT again this year. You can see what sets us aside. Net interest margin of 8%. You don't get that from banks, and you probably all understand why. When retail mortgages are being sold at 3%, and you've got to fund them, how are you ever going to make a net interest margin of 8%? So it's important to us to be focused on niche markets where we can make the return for our stakeholders. Something I'm very proud of is cost-to-income ratio. We've added about £2.5 million to our administration costs over the last couple of years as we've become a bank. That's the depreciation of the systems and the IT that we've had to put in place, but also the staff and the governance and the controls and the framework around the business as well. to actually hold that stable in a year where you're actually adding £2.5 million of cost to the business, I think is a great achievement. Earnings per share up strongly, and here's the return on equity, which is showing you the power of operational gearing. We raised the capital, 10.5 million. Our ROE fell to 8.7. By the end of September, it was 10.3. And this year, as I've already said, we're a year ahead of target. That'll be 12.5. So you can see putting that capital to work, operational leverage, driving profitability to the bottom line. Strategic initiatives. Continued strong growth in our long-established markets. Yes, we've been in them a long time, but we're actually penetrating a whole new part of those two markets. We're now, with our cheaper cost of funds, able to move more prime. Better quality customers should lead to a lower impairment charge as well, although our impairment charge is already quite low. And we only have a very small percentage of the market, so why wouldn't we keep driving that forward? But we also understand that they will become mature in time, those markets, and we will start to come on to some of our competitors' radars as a threat. So we're diversifying our balance sheet as well, with the acquisition of Azul, going into audio-visual, also the ability to go into Europe once things stabilise on that front, and also our move into bridging finance. At the moment, bridging finance is a pilot scheme of 20 million. We'll return to the board and actually say, we like what we see, it looks and feels and smells like exactly as we expected, and we expect that to drive forward into a significant business line of in excess of 100 million of portfolio within 2 years. It's a £4 billion marketplace, the property bridging marketplace. We've also got a big portfolio, a big database now of existing customers of good payers. So we want a digital presence to approach them, something when we're in the broker market we've never had to do. So we're increasingly developing our digital presence. We'll be approaching those 87,000 customers and driving the best sort of business into our model, which is returning customers. And we expect to see consolidation in the marketplace. We expect strategic alliances with people, affinity schemes of buying other people's database once we have an impressive digital presence, and we will diversify further into other asset classes. All the while, we'll keep investing in our people and our IT. We're a year ahead of where we said we'd be, so we need to keep on building the infrastructure of the business to make sure that we're fit for purpose and we're driving towards a balance sheet of £1 billion sometime in the future. So let's just finish up with the outlook. First 6 months of the current financial year, we're in line with market expectation. Those results, I said, are out on Wednesday, the 5th of June. We're targeting to write 250 million of new business originations this year and hit our 350 million portfolio target. We'll continue to increase efficiency and profitability through operational gearing. Our portfolio is becoming increasingly prime, so it's driving a low impairment charge already. But if all things being equal in the economy, that should drive even a lower impairment charge. But from a market expectation point of view, we're holding it steady because we do recognise that there's uncertainty around. We'll deliver strong EPS growth, and I've told you about our net interest margin and our equity targets. We fully understand the political and economic uncertainties around, but we are confident in our business model. We've seen it operate in more difficult times. It's robust, it's resilient, and it has the ability to prevail. Progressive dividend policy. Directly measurable targets. So these are things to take away when you're looking at us in June and you're reviewing our results. We're targeting a 3% return on assets. It's a great metric to throw out there to people. At a 350 million portfolio, that's 10 million PBT. At a 750 million portfolio, which is our next target, that's 20 million PBT. That's a serious AIM-listed bank if we're generating 20 million of PBT per annum. So our target there is 750 million by September 2022, and off that we're expecting to be driving a return on equity of 15%. So what you see here is an opportunity to invest in a growth business, an opportunity to invest in a financial services business. Financial services haven't been the flavour in the last 8 years, but and there's good reason for that. But here's one that's in the early stages of its growth, AIM-listed, a little unique, focused on niche areas, got a history of profitability, and the profitability starting to really accelerate forward as we use the retail deposits to really scale the business. So I think that's probably enough from me. As I said, there's a lot of appendices there. It's all granular, telling you a little bit more about our portfolio and a little bit more about the credit quality as well. Thank you.
Thank you very much, Scott. So I'll open it up to questions. I think we've got one in the middle there. It's about halfway down.
Thanks very much. I found that very interesting. I hope you'll forgive me for asking an industry question rather than a company-specific one. But I mean, you talked about legacy systems, and of course we've got Apple and Amazon and the others that have got stacks of cash, stacks of computing power, and stacks of data. Do you think they will disrupt the banking industry, and what do you think the overall effect of that might be?
I think Amazon are a threat, yes. There's no doubt about that. But, you know, I think they'll go fairly mainstream consumer. That's their market. So I think we just really need to be focused on niche markets that attract us. And I hope I've convinced you today that we're very focused on areas where we can actually get leverage in the marketplace and actually get growth ourselves. But in answer to your question, they have got stacks of cash, they have the technology, but there's a lot of fintech banks out there now as well. You may have seen the Monzos, you may have seen the Starlings, you may have seen the Atom Banks. All of them are gathering customer numbers, but they're not necessarily gathering profitability. So, you know, you have to have a model that's focused on returns, not just scale and customer numbers. I think the exit for those fintech banks is probably to be bought by another bank. It'll be consolidation, because I just think profitability for them is so far out. At some stage, they've got to start to have a return to their shareholders, and that'll come through consolidation in the sector.
Excellent, thank you. Do you have another question just here?
Yeah, looking at your presentation, you don't seem to have a high volume of transactions. So could I ask you what IT system you use? Where do you locate it? And I'm thinking in terms of cross-border regulations with Europe. And from your perspective, do you view Brexit as an opportunity or a disaster?
Oh, that's a multi-pronged question. Right, IT systems. Right, our business is driven through a proposal system, which is internet-based, and I think it's just written its 3 millionth proposal, so it's very scalable. It's bespoke. We had it built for us, and it's been developed every year since it was delivered. Our most recent systems are our banking systems. We spent quite a bit of money, as I said, on those. We've gone big on that as well. We've got a system called Temenos, which is run by some of the largest banks in the world. Of course, we've only taken something like 20 modules. We've only taken 3 of them. But with a view to having the best, we've taken the best. Where are they located? They're located in the UK. We run one of those typical, if my IT director was here, one of those typical triangular sort of diagrams where we've got head office and 2 other sites, both geographically diverse in the UK, to offer resilience and fallback on all our systems, including our back office administration systems as well. Brexit, I am worried about Brexit. I'm not worried about necessarily the fallout of Brexit particularly. What I'm worried about is the uncertainty that Brexit is doing to the economy as we stand here today. I'm concerned about businesses. I'm concerned about the lack of clarity that they have. And in some ways, although I have a preferred outcome for Brexit, which is to remain, what I really want is a decision. Because I have great faith in the UK business sector to adapt to change. We have a flexible workforce. we're dynamic, we're innovative. We will adjust, but we've just got to know what we've got to adjust to. And the longer we put this off, the harder it's going to be. So I would like it to be a Remain answer, but even if it isn't, I think we will adjust to it after a period of change.
Excellent, thank you. Well dealt with. Any more questions in the room? I had a question, Scott. You kind of hinted at diversification there. A couple of questions on that. So I don't know if you can talk about any areas that maybe you would be looking at, and also, obviously you have a very high net interest margin. Is there any risk that that would be diluted in the short term if you did diversify into a new area?
Well, yes, it could, and we do expect you saw on an early slide, you saw a net interest margin target of 7%, and we're currently achieving 8%. And that's because we're realistic enough to realise that as we go more prime, it's going to be very hard to keep our net interest margin at 8%. So we're targeting to keep it above 7%. It's been incredibly resilient since we've become a bank, and it's pretty stable. We won't move into products that don't deliver a sensible net interest margin. So you're not going to see us move into residential mortgages for the reasons I said, commercial mortgages, buy to let. Bridging does provide that net interest margin. Bridging typically falls at 0.6 to 1% per month interest charge for the period of the loan, so that makes those targets. It's hard for me to say where the opportunities will be. There could be another Azul. Yeah. Bridging was set up by actually taking a team of people from inside one of our competitors and setting it up organically within the business. I'm just as happy to do that. In some ways, I'm even happier to do that because you don't pay goodwill. It's identifying those markets. I would say they will be complementary to business or to consumer. So it could be, and this isn't any order of preference, just off the top of my head, it could be personal lending on the consumer side to complement our motor finance. It could be invoice discounting on the business finance side, which helps businesses with cash flow management now that banks have largely removed overdrafts from the marketplace. Or it could be cash flow loans or working capital loans for businesses to help support them. All of those things could be attractive to us. Or development finance alongside bridging finance. I think there's a whole scope of areas that we could move into. We've just got to spot the opportunity, understand it, look at the landscape, look at the regulation around it, which is an all-important thing these days, and then judge what the potential is in the future.
And it sounds like from the Azul deal, it was very much there as much about the quality of the business that you were acquiring and the management. So I guess that's clear. We are quite wedded to the idea of strong collateral assets. So Azul ticked that box. Route to market, dealing directly with Sony, that's a brilliant thing rather than being beholden to brokers, so that diversifies our routes to market. But yes, it's about so many acquisitions, and that's the fourth corporate acquisition we've made in my time. It's about the people. It's about the quality of the people who buy and their understanding of the marketplaces they operate in. And that would be key to any further acquisitions as well. Great. Any other questions in the room? Okay, thank you very much. That was great. Thank you,
Thank
Scott.
you.